Uncommon Sense. This is episode 59. Craig Kamanis is unavailable today, so I'm running a solo session. A couple of things that's been happening recently that I thought I would share with the audience is we had our annual planning day for my clients recently, and I gave a little bit of a talk about the future of the industry and a few things that are happening there. So I thought I would run us through some of those elements as we go through today. Hello to any people that are watching live on LinkedIn. I will try to keep my eye on the chat as it comes through. If you are listening live, thank you very much. And please jump in. If you've got any questions or comments, please stick it into the comments as we're going along. I will then know that people are watching and we can pick you up from there as well. So once again, I'll get started in terms of what I wanted to share today. So firstly, I gave a little bit of an introduction in terms of how I thought the industry was placed at the moment. I have begged and used said slides that are on the screen at the moment from some reports that were done by Deloitte and Iris. So thanks for them putting the reports out as well. But some of this stuff is known, but it's also really important to put it into context of the number of advisors and things that are happening at the moment. So first and foremost, from my perspective, what we know in terms of the number of Australians that have what I call unmet advice needs is $11.8 million. So that's not our addressable market. I think it's really important to understand that just because they've identified that 1 in 2 Australians need some type of advice, that won't necessarily be provided by strategic, high service financial advisors. There'll be different types of technology for the vast majority of those people, and we'll look to tech providers or industry super funds to provide the solutions for 10 of those 11.8 million Australians. The next category down of this 486,000, this is the number of clients that are going to come through over the next 5 years. This is pretty consistent. There's been a variety of different data points that might say it's between 400 and a million Australians that need advice over the next 5 years and are willing to pay for advice. Interesting one that came through is actually the amount of revenue for revenue increase that's available. And so $2.1 billion is the revenue uplift. And so this is really a big reason why you can see lots of people wanting to invest in advice practices overall, is that revenue is a significant amount of revenue upside as a result. And I think it's really important, if I just go over to the next slide, this is from Advisor Ratings. This is the decreasing advisor numbers as a result of, I'll just go back to the big slide, just navigating this all at once. This is the decreasing advisor numbers. And so what I found was really interesting with this one was actually that whilst we know that the advisors are decreasing, the advisor number decreasing over here, what the most important things that we're not really always talking about is the component that is stockbrokers, for example, in this chart. And so for those that are colorblind or not following along live, there's somewhere between 12% of the 15,000 advisors that are stockbrokers, for example, another 4% that are working within the industry super funds, for example. And so why this is interesting is that although we quote this running number of 15,000, perhaps there's somewhere between 10 and 13 or 10 and 12 1,000 advisors that are actually on the tools doing strategic advice that are going to fill the bucket of these ones that I talk about, of the 486,000 Australians that need advice overall. And so this is the big opportunity that we have within our industry to take advantage of. We know the advice fees are increasing. They've been increasing every year since 2018. The cost to deliver advice overall might have, the products might be becoming cheaper with technology and scale. So I think it's a decreasing game for Our product providers, in terms of the basis points fee that they may charge, is heading towards zero. Won't ever get to zero, but if you look at the US, for example, it's much closer to zero than what some of our providers are today, in a much, much larger market, of course. Same with investment management. I think the rise of managed accounts, asset consultants, and the indexing investing or lower cost investing overall has meant that margins come down. And then the advisor most definitely has been able to maintain their margin. I think, frankly, because we are having the relationship and the long-term relationship with the client. And so I think that that's the most important thing that comes out, is that our advice margin is steady and clear and growing over the next few years. And so if you haven't reviewed your pricing strategy within your business, I think it's really important. The next couple of weeks I'll interview a guy from Peloton Partners, David, who will just take us through some of these pricing philosophies, because I think it's really important that we focus on charging the right price per client. And if we can learn some lessons from others around that, I think it's really important. But the average fees have been increasing over time. The report identified 7 mega trends in terms of what was out there to think about for the next few years. And so I sort of chose 4 of these that I thought were the most interesting. I'll put the link to the Deloitte Iris study overall. What this chart spoke about in terms of embracing the mega trends was actually the way in which you need to think about it. So customer, business, specialization, and technology are 4 hats, if for want of a better word, that you can think about these mega trends in. So we want to understand the customer side of how they're thinking and making decisions. What's the right business model to take into account these mega trends? What level of specialization is needed to provide the advice, and then what technology is needed, if it's one-to-many or technology first, or if it's bums on seat in terms of advisor talking to client. So obviously, this chart is just going at the top end of the table. We've got high complexity, high fee, personalized advice. And so the clients that I work with and the businesses that I talk to predominantly solve complex problems. They charge a high or reasonable fee for the work that they do, and it's highly customized and personalized to their situation. And so it's not overcharging clients by any means, but it's making sure you're charging the right fee for the deliverable and the value that you create for customers overall. So some of the mega trends, although they are not new, it's a good idea just to hear them again and again and again, and really think about how we're focused on these from the customer's perspective, not just from the financial advisor business perspective. And so skyrocketing retirement demand is a known. And so the 2 things on the screen that's really important, and you can read the entire report, of course, but firstly, the retirement demand in terms of the age and stage is they want to do face-to-face consultations. It's very difficult to provide this type of advice in a one-to-many scenario because there are a lot of moving parts. Now, face-to-face doesn't mean you have to have a physical client meeting. You can easily deliver face-to-face over Zoom, over the Zoom and the Teams and the internet, of course, but it's very traditional in what we know and understand. Okay, so I think that was the first insight that I took out of this. What I know as a result of dealing with the skyrocketing retirement demand is there are numerous strategies that we can implement, but also numerous paths that clients need to be walked down in and around this. So any business that is focused on this area, obviously it's a growing target market and it's a growing need throughout the retirement. Hopefully clients live till well into their 90s through this process. Second mega trend that I thought was interesting to call out for those businesses that are either working with younger Australians, 25 to 45-year-olds, and or those businesses that are wanting to identify and talk to that younger generation. So if you've got an older client book, for example, you may have a desire to talk to younger Australians. And so one of the ways in which you can talk to them is speak their language and understand their problems, okay? Or their challenges, not necessarily problems. So this new the language around this I thought was quite interesting in terms of just calling it the new Australian dream. So rephrasing what was the previous Australian dream of the quarter acre block with the clothesline out the back, etc., etc. We're trying to think about that in terms of what a new Australian dream might be like, and how do we use that in all of our marketing, communications, and stories with clients overall that are in this different age bracket. Okay, so once fees and personalization, I think it's a really good call out. It's still at a 3, so it's still a need for face-to-face, one-on-one problem solving, but definitely there's a rise in the technology delivery of this advice. So if you're using the My Prosperity or other client portals, I think this is essential in order to talk to the Australians with this new Australian dream. But the advice fees are still significant, so they're willing to pay for great strategic advice that is personalized to their situation to help them navigate this concept of the new Australian dream. If you're trying to squeeze younger clients into your existing advice process or your existing advice model, you're definitely going to have some challenges around that. The example that I've always shared in the past around this was actually the example between Qantas and Jetstar. And so Qantas, when they decided essentially that they were going to set up and run a lower cost business, they didn't simply just start offering tickets cheaper in order to achieve that. They actually obviously created a brand new brand. They created an entire new business unit with a different CEO, a different strategy, different technology, different planes, and different booking system, etc., etc. So when they decided to make Jetstar, they didn't follow all of the old historical mistakes or situations of Qantas. And so I want that to be a little bit of a takeaway in relation to your business if you're looking to target and help 25 to 45-year-olds understanding that there is a new Australian dream, or they have a different goal that your older clients might have not articulated or have it as a problem. And so you have to be thinking about, well, how can I build Jetstar next to or within my existing financial planning business? Don't just give them what you've always given your other clients. Next mega trend, which we continue to reiterate, is take this for your existing financial planning businesses is digital everything. So what I mean by this for our existing financial planning businesses is clients are still now and forever expecting to have the iPhone/Google experience when it comes to dealing with their financial services overall and their financial services provider. And financial advisors have a bit to catch up in and around this. But if you think about how seamless Shopify is in terms of the shopping experience on phones, Shopify powers a significant amount of the online shopping engines or stores, and the experience is really seamless, and their call or their value is that they actually, because of that seamless experience, more sales are transacted per business if your business uses Shopify than anything else. And so why is that useful and important is just thinking about how individual businesses can serve more clients, serve them faster, serve them in a way in which they are comfortable to be served is a digital interface. And so if you think about that in terms of your current business, how we having a digital and physical experience for the client. So you still might have face-to-face, but then you might have your digital portal or app alongside in order to provide that secondary point of contact into the business. Fourth one that I identified in terms of what I was sharing with my community was intergenerational wealth transfer. So this is happening right now, and it's been happening for years, and we've spoken about it. Jan and I laughed that we've been speaking about this now for 15 years. Everyone forgot that medical advancements has meant that we kept people alive for much longer than what we statistically thought we would. Now, The interesting thing about the intergenerational transfer is that our clients, typical client would be 55 to 65 years old. And so they have two challenges because they have their children coming up and in their mid 20s or 30s, and they have their parents in their 80s and 90s. And so typically when we think about the intergenerational wealth transfer, we have to think about who our primary client is and then where those secondary clients are and how we can help. So depending on the age and stage of your client book, you actually find that you can go both up to the older clients and down to the younger generation in and around this, and actually have almost a three-tier generational strategy. And so you have to be ready for these conversations. The old Wealth Enhancers tagline was, your parents' financial advisor is not your financial advisor, is really relevant just to be motivated. And that goes back to the second slide about the new Australian dream, is just because you've got children of your current clients and you know their name does not mean that they're willing and ready to be advised by you. And so 55 to 65-year-old clients, I want you to think about how we go up to the 85s, and that's estate planning and legal documentation, I think, at that point in time. And then the lower generation, we've got to think about how potentially the parents are setting those children up for success, not necessarily in helping them buy houses, but actually just helping them get set up, educated, get invested, and get on the right strategy. So this grey tidal wave, as it's spoken on the screen, has a lot of different facets to it that we can talk to. Ultimately, you need to work out who your client is first and foremost before you can talk to those others. The other thing to be mindful of in relation to this is just the whole aspect of how different generations might want to pass their money down. We want to move it relatively quickly. I was talking to Craig actually earlier today, even though that he couldn't come, and he's an executor on an estate. And being an executor on an estate is an incredibly complicated and time-consuming job. And so if you can talk to your clients today, 55 to 65-year-olds, and say, let me help you think about how I could make your executor job easier when your parents pass away, getting organized from that perspective is actually really exciting. And that's going to engage your client on another service level at the 55 to 65-year-old range, and that's going to keep them on your business for much longer. So they overall were some of the slides that I wanted to share in relation to what I was thinking in terms of the future of the market overall. The other thing, I just share one more slide that I thought was quite interesting. I think it's interesting. I hope the audience will see and agree. But essentially, I gave a little bit of a technology update as well. I won't share all the data here. And I apologize, it's not coming perfectly clear on the screen at the moment. I wish that I could get the chart. I might go full screen. So I wanted to show you this chart on the right-hand side here where my face is. I'll see if I can get it properly up on the screen. Please bear with me. No, I can't. Anyway, so on the right-hand side of the chart that isn't actually coming on the screen at the moment is the processing power of all of the NVIDIA chips overall. Now you can see a giant one there that's actually just appearing on the right-hand side, which is Microsoft, and Facebook or Meta is right next to it. And so what I found really interesting in terms of who owns the processing power of these large language models and how accessing the physical computer chips is now actually a determinant of future success. So in the past, you could have a tech-based idea in terms of startup, and the tech-based idea in terms of a startup would mean that you needed to program something. Whereas the new version is you need to be able to program something first and foremost, but you need to have access to the computing power in order to train and run the AI large language models. And so there's startups today that have great ideas, but are not able to attract the staff, not based on the salary that they're willing to pay the staff, but the staff member is saying, look, I really like your idea. I'd like to work with you in your startup, in your AI startup. How many processes do you have access to? And so that's a question that people are asking. And so Microsoft and Meta have access to the most processing units, these NVIDIA chips. And so what I found really interesting is that people aren't going to work for startup competitors because they don't have access to the chips available to them. And so from my perspective, knowing what Copilot within Microsoft is doing and will do in the future, it was sort of this self-fulfilling prophecy that it will be, the Microsoft Copilot will be even better in the future versus other startup technologies, simply because they have more technology to train the models over time. So I thought that from my perspective was really interesting in terms of the number and the processing power that's available to everyone at the moment. So that's it for me today. So a little bit shorter because no one was asking me any questions. Craig Kamanis said he would be back next time for episode 60, I believe. We're doing really well in terms of the number and consistency of our effort. Pat on the back for Craig and I as a result of that. So thanks, everyone. If you have any questions or comments, feel free to reach out.